My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. If you want to make friends, I'm just trying to save you some money. My job is not just to entertain, but to put all this stuff in context, because it's real hard right now. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Sometimes the hurdles just seem too high. The gauntlet too hard. Today is one of those times. Dow plunging 367 points. S&P plummeting 1.16%. NASDAQ tumbling 1.08%. And it was much worse at one point today. There's just too much to process going forward. So people, what do? They sell, sell, sell. Sell, sell, sell. Sell, sell, sell. Sell, sell, sell. Yep, those are 4 sells because we've got 4 potential negatives that are worth selling for. Actually rational. First, there's tomorrow's Fed meeting. Then there's the quarterly report from Apple, the biggest company on earth. Then there's the Labor Department's non-farm payroll report on Friday. And finally, there's the debt ceiling debacle. Those are 4 legitimate reasons to be concerned. If it were just one hurdle, we'd be fine. But with 4 of them, everybody wants to sell in May and go away. So why don't we take them one by one, unpack them so we can deal with them in a rational manner. Let's start with what's staring us right in the face. That's tomorrow's Fed meeting. We know people are prepared for a quarter-point rate hike, but we simply don't know if the Fed will pause its aggressive tightening after that. Fed Chief Jay Powell's been terrific at telegraphing what he'll do. I hope we'll call on selective reporters this time because any surprise must be avoided. This time, though, the fine line of surprise versus forewarned is being blurred because the mini banking crisis may be equivalent to multiple rate hikes worth tightening all by their own, right? And we just don't know yet, and neither do they. I've been saying that the bank failures might be equal to a 100 basis point rate hike. That's right, as if the Fed were to raise hikes by 100 basis points. If they did that, that's what I think is happening with the regionals. Now, it made sense after Silicon Valley and Silvergate and Signature went under in March. Then First Republic was temporarily saved by the big banks, depositing $30 billion to show their confidence. But in the end, even those extra deposits couldn't save them, and the FDIC had to facilitate a ridiculous 3 a.m. shotgun wedding with J.P. Morgan before the bank opened yesterday to prevent a disaster. And now I'm wondering if J.P. Morgan's the only big bank that can save us, are we really at a place where the Fed can afford to tighten at all? Lately, every time the Fed raises the short rates that they control, long-term rates go down because that's what happens when people think we're headed for a recession. That makes things tough for the Fed. When long rates go down, mortgages get cheaper and housing gets stronger. But the Fed wants to crush housing inflation, so it's like they've got no way to win. Yep, the Fed's caught between a rock and a hard place. If they say they want to wait and see what happens after tomorrow's rate hike, you could legitimately say, hey, we know what will happen. Things will get worse in banking and housing. If you want help gaming the Fed before its afternoon release, stay tuned. I've got a full breakdown of what are the different options and odds. The second hurdle is Apple. Unlike the Fed, we really have no idea what Apple will say or do. I always say own it, don't trade it, and I'm sticking by that. However, Apple stock has moved up dramatically based on, well, who knows what? That means the quarter has to be pretty darn perfect for the stock to keep climbing. Hey, we saw that tonight. AMD moved up. They reported a good quarter, and then bingo, right back down. I don't see how Apple could really have that same thing happen, but we know without a new iPhone, stable Chinese market, with a growing Indian market, we don't know what's going to happen. Sure, Apple could pull it off, but given how much the stock has run, every line needs to be better than expected. We didn't get that from AMD. We may not get it from Apple, and it's a tall order. So let's say we get past the Fed and past Apple. What do we have then? Well, then it's the employment number on Friday at 8:30. Remember, again, it's actually numbers, not number. You have the unemployment rate, you have wage growth, you have the labor participation rate. I think parts of this economy are still strong, but I worry about the impact of less lending from the regional banks that I talked about earlier. Plus, at this moment, we don't even know what we want on Friday, do we? If the Fed tightens and the labor numbers are weak, that looks like a hard landing. If the Fed says they'll pause the rate hikes and then the job numbers are hot, well, the Fed looks like it goofed. kind of untenable, don't you think? Either way, Wall Street won't want to see a labor report that's too weak or too strong. That's a tough needle to thread. Can Jay Powell finesse this issue? I bet he will, but it won't be easy. Finally, there's the debt ceiling fiasco. Yesterday, we found out totally out of the blue that we might have less than a month to do a deal before the government runs out of money. That was shocking to me. I was very upset about this. Treasury Secretary Janet Yellen painted a picture of Uncle Sam defaulting on his obligations by early June. That was a gut punch. It made me feel like 2011 all over again. Back then, we all knew the Democrats and Republicans would eventually have to compromise. However, the market almost systematically declined day after day, falling more than 19% peak to trough during that debt ceiling wrangling, with the brunt of the fiasco coming when the Standard & Poor's the actual organization, Standard & Poor's, the rating agency, downgraded our government's debt. This time around, I'd argue we have an even more divisive political situation with hardliners on both sides. It's a real game of chicken now, not a faux one, because there are plenty of Republicans in Congress who I believe a default might help them win the White House next year. What's a few missed bills by the government not paid compared to storming the Capitol building? I mean, I think it's more worrisome than 2011, so it's understandable why people want to get out ahead of the carnage. Now, all of these issues would be much better and much easier to put to bed if stocks were lower. And that's what's happening. Stocks are going lower to adjust to the 4 hurdles. But there will have to be changes made, too, before selling subsides. The FDIC, they can't just default to J.P. Morgan anymore. That's ridiculous. They got to come up with a plan that spots the regional banks some points so they can bid on and win the next bank that goes under. Or they need to levy a big enough fee on the industry that lets them raise the deposit insurance to at least $500,000. If only to prevent more bank runs so the FDIC protects your interests. So the Fed has to raise rates tomorrow, say the risks have gotten closer to recession, so we're going to wait and see how much damage has already been done. More on that later in the show. Apple will report what it reports, and if it's weaker than expected or the forecast soft, then the stock will go down. But then come back again, I believe, because there are too many things going right for this great company over the longer term, including its own AI. When the labor report rolls around on Friday, we want wages to stay steady or even come down a bit. That's what will allow the Fed to stop tightening for good. I think it'll happen eventually. I don't know if it's going to happen Friday. Debt ceiling crisis will be resolved, but maybe not until the national parks are closed, the government sells off some big parcels of land or spectrum or anything else that's not nailed down. Maybe no Social Security checks will be missed, though. There could be a hangover for what happens, though. It could be a little like 2011, before she go down a lot. But you know what? You had to buy it when we got near the bottom because, boy, did we have a good run after. Think about that as you sell or if you sell. It came back. I know these might not be satisfactory outcomes, but we've been selling what we can for the Charitable Trust pretty much every day. We're not selling to flee from the market, as we told members of the investing club over and over. We're selling to raise cash so we can afford to be opportunistic and do this buy, when the stock market goes down, and not this sell. And this, as I see so many others. Bottom line, it's not a bear market, just an interlude. And you have to recognize these 4 hurdles are a gauntlet, a real gauntlet that must be traversed. But those who beat it will get to the promised land of great profits. Not yet, though. Patience is needed to get through this period and a dose of fortitude while we're at it. Sunny in Illinois, Sunny.
Hey, Jim, a big Chicago Windy City booyah to you, partner.
Love it. A Binny's booyah since I was out there going to them last time. I love it. What's going on?
Hey, man, this stock market is scarier than Halloween. What's going on?
Well, it has an edge to it. Let's put it that way. We've seen these sell-offs before. We're going to see them again. How can I help?
All right. Well, so I'm looking at a company called Cisco. They posted a pretty strong quarter last time around. What's your take if you think they're going to post some strong numbers this time? Do I got your blessing to buy the stock?
I think that the stock is kind of stuck, and I don't want kind of stuck. I want a stock that's going to go up. So I'm going to say you got to get a stock that I think can have a real run when it reports a good quarter, and not a run and then a fall right back down to where it was. Let's go to Eric in Michigan. Eric.
Hi, Jim. Big fan of the show.
Oh, thanks, Eric. Thanks for calling. What's going on?
I'm calling on General Motors today, Jim. Earnings were about a week ago today. Ever since earnings, the stock's been down over $1. Earnings of $2.21 a share versus a street of $164, so they blew the street out. The bottom line, Jim, rose from a year ago quarter's earnings of $2.09 per share. Revenues of $39.98, beat the street at $38.87. The adjusted EBIT forecast was revised upward from 11 to 13 billion, from 10 to 12.5 billion. The adjusted earnings per share is expected in the band range of $6.35 to $7.35 a share, which is up from the prior forecast.
Look, Eric, I got to tell you, I can just stop you and tell you I'm with you. And I told Mary Barr on air and off air, I thought it was an excellent quarter. But you know what? People are worried about they're worried about internal combustion engine sales going down, and they're worried about competition in EVs for the first time. So what's going on is that people feel the profit margins are going to be crushed going forward. But I agree with you. I think GM's at a very interesting level, and we will have much more about Ford for the CNBC Investing Club this evening when Jeff Marks puts out a great piece. I saw a lot to like, but it's looking a little like what we saw with GM, and it's annoying. It's annoying, but there's more to it. All right, these 4 hurdles are a real gauntlet that must be traversed. But those who can traverse them will get to the promised land. Mad Money today, could the parent company of Burger King be crowned the winner in the fast food space? I'm checking in with the chairman of Restaurant Brands International to get the latest story. Then just ahead of tomorrow's Fed meeting, I'm sharing the odds of what can happen and what won't. And then Logitech jumped higher today after earnings. So what did Wall Street seem to like in the tech accessory company's quarter, or is it a dead cat bounce? We're going to have to dig into the details for the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.